The faint hopes of the central banks slowing down rate hikes got squashed last week when the U.S. Fed Chairman Jerome Powell said that they will continue to raise interest rates in the coming months, which will cause pain for households. If the Fed shifted gears and decided to slow down rate hikes, that would be plan B, which would be positive for stocks and real estate. But now that the original plan is now affirmed, this just means that nothing will change and we'll go ahead on schedule with our next rate hike in Canada on September 7th. Right now, the majority think that rates will increase somewhere between 50 to 75 basis points, and I'm pretty sure we're going to see some more scary headlines for Toronto real estate after that. The media is made to induce anxiety, and at the same time, it might not give you the full picture. So in this video, I want to try to help you read past those scary headlines and truly understand how the next rate hikes might impact the Toronto real estate market. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you don't miss other videos like this made specifically for real estate investors in Toronto. If we take a look at the latest 2-year bond yields, you can see that we've reached the highest rate since 2007. In simple terms, this just means that the consensus is now betting on more rate hikes. Right now, the Bank of Canada's target rate is at 2.5%, and the central banks have already said that they will front-load rate hikes to tame inflation quickly. The big banks see target rates going up in the next few months, with bigger jumps in September and smaller jumps in October and December, and then peaking somewhere between 3.25% and 3.5% by year end. And based on this, mortgage variable rates should peak somewhere between 4.75% to 5%. So let's cut to the chase and see how this might affect real estate. Honestly, in our investment analysis projections, we've been using variable rates of around 5% for a while now to figure out what is a good price to buy. So if Bank of Canada is sticking to the original plan as before with more rate hikes, which was as expected, nothing actually changes on our end. At current levels, with future-proof rates of 5%, we're seeing deals with good cash flows and our clients are starting to buy. Of course, not everyone is as in tune with the market as we are, but as more and more people start to notice this soon, we're going to see more buying action, which will give support to the investment property market. The end user side is a different story. Home buyers here are much more likely to buy based on what they can afford at that specific time. If mortgage rates are right now at 4%, they're going to use 4% to figure out how much they can borrow, and that will be the maximum price that they'll be willing to pay for a home. Once mortgage rates rise to 4.75%, they won't be able to borrow as much, and so that will lower the ceiling for their purchase price. Now, based on CMHC's calculator, if rates go from 4% to peak 5%, the amount end user home buyers can borrow will drop by 8% from today. The key difference here is that future rate hikes haven't been priced in by end user buyers, and so prices in end user markets will continue to react, lag, and fall as interest rates go up. In my opinion, I think that even though investment properties do have a stronger support, the power of confusion and fear is pretty strong, and we are going to see more weakness in both the investment property market and end user markets after September's rate hike, which is also expected to be pretty big. Real estate is an easy target for news, and it will scare off sellers in the investment property market too, which actually means more investment property buying opportunities in the fall. Remember, the real estate market isn't as efficient as stocks, and even though the general investment property market might be stable, there could be a potential that you might meet a seller who might let go for a lot less because of fear. Here's the thing, the numbers are already working on many properties based on forecasted peak mortgage rates, and we're already seeing good cash flows. Any future price drops from here on will just give you those Black Friday deals of the year. So if you see it, act quickly because it could be as good as it gets. Once we see clearer signs that rates will be stabilizing closer to year end, the investment property market will see a much quicker influx of investors. And this will give stronger supports to prices and translate to a less buyer-friendly environment with more buying competition, fewer conditional offers, and more time-sensitive decisions. So, what do investment properties look like in Toronto these days? Right now, we'd say that it's possible to get a house in Toronto for around $900,000 with major renovation work that's around $100,000 at least. And after you do those upgrades, you'll be generating positive cash flow of around $300 per month based on the future-proof 5% mortgage rate. And if you want to get more details on opportunities like this, just reach out to us. We're a real estate sales brokerage that focuses specifically on investing in freeholds in core Toronto, and we search the market daily to find the best deals out there. We can take a look at your requirements and preferences and then match you up with the best investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.